Gentlemen, a very good evening to you all. Thank you for joining us on the third quarter earnings call for financial year 2018. A snapshot of company's quarterly performance is as follows. Turnover is up by 10.3% at rupees 1,205 crores as against rupees 1,093 crores last year, led by volume growth across all three businesses. Tractor volume is up by 11.6% to 18,930 tractors as against 16,963 tractors last year same quarter. Construction equipment volumes are up by 33.4% to 1,087 machines against 815 machines last year same quarter. EBITDA at rupees 145 crores against rupees 91.5 crores last year is up by 58.5%. EBITDA margin now stands at 12.04% versus 8.4% last year same quarter ended December 16. PBT from continuing operations at rupees 129.5 crores, up by 71.1% as against rupees 75.7 crores last year same quarter. The company reported a PAT of rupees 92 crores versus 22.7 crores last year, up by 305%. PAT margin now stands at 7.6% versus 2.1% last year in quarter ended December 16. EPS is reported at rupees 7.70 against rupees 1.92 last year same quarter. Now moving on to segmental business performance, starting with the agri machinery businesses. Domestic tractor industry volumes grew by 7.9% to 1.77 lakh tractors as compared to 1.64 lakh tractors last year same quarter. Our domestic volumes went up by 11% at 18,418 tractors against last year's 16,600 numbers in quarter ended December. Industry in our strong markets, North and Centre, grew by 6.1%, whereas industry grew by 10.3% in the opportunity markets of South and West. Our domestic market share stands at 10.4% in quarter ended December 17, is up by 30 basis points as against last year's same quarter. EBIT margin in EAM in the agri business stands at 14.6%, up by 421 basis points against 10.4% last year, primarily due to operating leverages and the cost reduction initiative taken by the company. The market response for the higher HP models introduced under PowerTrack and FarmTrack brands has been positive and encouraging. Our market share increased from 6.6% to 8.1% in 50 HP plus category in first half of this fiscal. In the PowerTrack brand, we launched new models with highly advanced hydraulic lift technology called Sensi 1 in our stronger markets. In current quarter, we had launched new compact tractor range called the FarmTrack Atom series for orchard and vineyard applications in domestic market. Going forward, we are launching new FarmTrack four-wheel drive, specially designed for potato farmers. We expect domestic tractor industry to grow by 15 to 16% in current fiscal. Coming to the construction equipment business, our served industry grew by 21.9% in Q3FY18 with respect to last year. Material handling have been the biggest gainer in Q3FY18 with growth of 70%, followed by compactors with 17% and backhoe loader segment by 16%. Our total volumes manufactured and traded products went up by 33.4% to 1,087 machines in quarter ended December 17 against 815 machines in last year's same quarter. EBIT margin for quarter 3 ended December 17 at 2.2% is up by 462 basis points as against negative margin of 2.4% in same quarter previous fiscal. Going forward, we expect that our served construction equipment industry will continue to grow at 18 to 20% range for FY18. Coming to the railway division, the revenue at rupees 72.03 crores in quarter ended December 17 is up by 24.2% as that of rupees 58 crores last year same quarter. EBIT margins are up by 202 basis points at 13% as against 11% last year same quarter. Order book for this division stood at approximately 330 crores as of 31st December 2017, which will get executed by next fiscal. Now I request the moderator to open the floor for Q&A session, please.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. We take the first question from the line of Nitesh Sharma from Phillip Capital. Please go ahead.
Good evening, everyone. Congrats on a good set of numbers. Sir, we've seen tractor segment margins improving sequentially despite RM pressures and 7% drop in volumes quarter on quarter. So what has really worked for us? Is it the mix, cost control, something else? And do you see further cost reduction scope which is achievable in this and the next financial year in the tractor segment?
So it's a combination of all the factors, I think what you mentioned. So like you said, the company has been working on the cost initiative for the last 2-3 years, and that initiatives are on as of now. So obviously on the both on the manpower cost side as well as on the material cost side, I think the work is happening now, and we expect I think the momentum will continue. Maybe we'll see some further saving happening next year too. And obviously there's another reason is the leverage, operating leverage what we're getting with the higher volumes coming in this year. So that's another thing which has actually helped us in getting the overall improvement in the margin. And second, if you compare with the last quarter also, so in the last quarter because of the GST transition, we had some one-off impacts which were factored in. So if you remove those impacts, the margins should have been quite significant in last quarter also. So there's not really a major change compared to last quarter, but yes, about 150 basis points improvement has been there on account of the better cost initiatives here in this quarter.
And sir, we've taken any price hike during the course of the quarter?
So we had taken a price increase in last quarter in Q2. So in Q3 there was no price increase. So there's another one which we have taken is in Q4.
And what would be the quantum for the same?
So roughly on a full year basis, it will be about 2.5% sort of price increase has been taken.
Okay, got it, sir. And any color on how is the demand on the ground for the industry, and what is the outlook for FY19 that you're looking internally?
So on a full year basis, we expect the industry should deliver about 15-16% growth, and Q4 probably will deliver a better growth numbers now. So we are looking at probably it will be a pretty aggressive growth. Maybe could be anywhere between 20 to 30% growth may happen in Q4.
15 to 16% for FY18, correct?
Yeah, for the full year.
Okay, and for FY19, what you guys are looking at?
So FY19 probably it will be somewhere between 7 to 8% is what we are looking as of now. But obviously a lot will depend on how the things will move and also how the government policy initiatives are taken and how the monsoon going forward in the next year. So what we expect still I think FY19 will be a peak year, another peak year for the industry.
Okay, got it. Sir, secondly, on the railway segment, what is the current order book and where do you see this heading?
So as we mentioned, the order book size as of 31st December was 330 crores, which will get executed in next 12 months or so.
Okay. And how our program as far as localization of content for AMBS, BMBS, where do we stand on that?
I mean, we are on that process of localization, and that's why you see a regular continuous improvement of the margin or the EBIT margins. And we are introducing few new products also, which we will announce in the coming quarters.
Okay, great. Thank you, sir. I'll come back in the queue.
Thank you. We take the next question from the line of Jatin Chawla from Credit Suisse. Please go ahead.
Yeah, hi, good evening, sir. Congratulations on a good set of results. First question is on the tractor side. I look at your average realizations and they've gone up almost 2% on a quarter-on-quarter basis. Is this largely a function of the price hike, or is there some mix changes also in there?
So like I said, there are two reasons. Essentially, one obviously was the one-off impact which we had taken in the last quarter. So that itself was roughly about 12 to 13,000 rupees per tractor. So roughly 25 crores for the one-off impact which was built in the last quarter number. So that is one of the reasons why this time we're looking at a slightly increased number. Then also in the overall revenue, there is a non-tractor revenue which has also moved up compared to last quarter. So which normally is about roughly 8 to 9% sort of level. So this quarter the number is slightly higher than the last quarter. So that is another reason of about 5 to 6,000 realization getting additional because of that. And obviously third is the price increase which we taken in Q2, so there's a full quarter impact coming into this quarter. So that's another reason for the improvement in the realization on tractor business.
In terms of market share, we haven't really seen any significant improvement in the 9 months period so far. How do you see that shaping up in the next quarter and in FY19?
Okay, yeah, that is true. I mean, our market share for the 9 months is pretty much flat, but if you look at Q3, there is a slight improvement. So market share for Q3 stands at 10.4 as against 10.1 same quarter last year. And we have a detailed plan to increase market share to our aspired levels. So we are working towards that.
Any target number you would like to share?
See, from 4 to 5 year time frame, our aspiration is to touch 15% market share, as we have been saying earlier. So our plans are tailored according to that goal.
Okay. And on the tractor EBIT margin side, last 2 quarters have been very strong, and it seems we will very easily exceed the guidance that we had at the start of the year of 100 to 150 bips increase. We might actually end up doing a lot more than 200. So where do you see margins going? Do you think that these margins in the last 2 quarters, there has been some GST kind of benefits that the industry has had, and over a period of time this will be shared with the consumers, or do you think this is sustainable and we can build on top of this with the cost initiatives that we are taking?
So like you mentioned, we had given a guidance of roughly 150 bips improvement in the margin in this year. And on top of that, because of GST, so it's not a real gain which is there, but because of the GST rate going up, so top line has gone down by roughly 7% from 1st of July. Now that has led to some numerator denominator adjustment based on which our margin has improved by 70 basis points. Now there is no actual gain which is flowing in, but it's only a notional adjustment which has happened. So if you combine the two, so roughly 220, 230 basis point improvement is something which we in any case had given the guidance for. So yes, if anything happens beyond that, then it will be a positive surprise for us. But as of now, we look at the number will be in that range only.
And on the railway side, this increase in order book that we have seen from the previous quarter to this quarter, anything that has come from additional product, or we are still out of the 7 products, only 3 have been kind of approved and where we are getting orders?
The present orders are from the existing products which are under approval. The new products which are in the validation phase, we have only developmental orders. So all the 330 crore of order is primarily of the products which have already been approved.
And for the new products, when do we start expecting?
We have developmental orders. They are under validation period. So we should be another 1 or 2 quarters. We should be ready with those products also to get fully commercialize those products.
Okay. Thanks a lot.
Thank you. We take the next question from the line of Hitesh Goel from Kotak Institutional Equities. Please go ahead.
Thank you for taking my question, sir. Sir, first question is basically if I look at railways EBIT margin, it has declined by 300 basis point on a Q1Q basis. But if I look at the revenues, it has not changed much. So can you just shed light on that? And also, if I look at the employee cost on a sequential basis, gone down by 9%. So can you throw some color on that as well?
Yes, on the railway point, like you said, one is obviously the issue on the product mix side. So otherwise, we look at on a full year basis, still I think the numbers will be somewhere between maybe somewhere around 14-15% sort of EBIT range. So since this will lot depends on what sort of product mix is getting sold in each quarter. So in the first quarter we had lower margin and then went up to 16, then it's 13% this quarter. It will be back to 15-16% level again in Q4. So I think on the overall basis, it will still be in the range of 14% sort of margin for railways. Coming to the manpower cost, obviously, like you said, we have been working on the cost initiative with the consulting firm, and this is one of the key area of concern which we had compared to the competition, and there's a benchmarking and there's a profitability gaps. So obviously, this remains a focused concern area for our future also, and we'll continue to work on the rationalization of the manpower cost. So we have been able to achieve 0.5% reduction this quarter, and we hope to really improve it further going forward, I think in the next year.
Okay. Sir, but can you just shed more light on this, raw material cost reductions? Because raw material costs per se are going up. So are you consolidating the suppliers per se, or there's a big VAV program which is going on? Because in a quarter, reduction of around 0.5% looks too much. So can you just shed some light on that? How are you achieving this now? What is the process going around?
Yeah, so companies, like I said, so the VAV initiative is still on. So obviously that's something which we think there's some juice left now, even after doing the major project in the last 2 years. And that effort again is continuing, and we expect that process will continue. So our entire target is if we can beat inflation with the kind of cost saving which we are able to do through VAV initiative, and that's something which will be a good challenge to take. So that's what the company is actually looking at internally in terms of the future reduction exercises.
So once the scale of tractor business volumes, if it comes down, the industry goes through a bad phase, then at least in gross margin, we should not see much deterioration because these are more sustainable gross margins. Am I right on that?
Well, like I said, our entire target was that even if the industry remains constant in the next 3-4 years, we should be able to sustain double-digit margin in tractor business. So that's the target what the company has taken, and working in that direction only as of now.
Okay, sir. Great. Thank you.
Thank you. We take the next question from the line of Mitul Shah from Quant Broking. Please go ahead.
Good evening, sir. Congratulations for good set of number. Thank you for taking my questions. Sir, I have question on construction equipment. Sir, can you give more details on new product launches? And second thing on the margin side, what is the visibility on the FY19 as well as Q4? Hello?
Ajay, can you take that question?
Hello?
The earning calls you can take, but as talking about new products, we have launched a couple of new products last year and last quarter as well, and there are a number of variants that we have launched within the product. So today, as of now, we see 23% contribution coming from the new product segment or new product that we have launched last quarter.
So on the margin front, Mitul, I think this year, like you said, we had given an indication that we'll be breaking even and maybe slightly positive on the operating margin side, which is what I think we are looking at now. Looking at the numbers for the current quarter, and next quarter also will look like a strong quarter for us for construction. So on a full year basis, it will be a slightly positive number on operating margin, and next year probably we can look at somewhere around 3-4% sort of EBIT margin on this business.
And is there any possibility going further up or anything major we are doing to increase the margin to say 5% plus, higher single digit?
So it will be, so like you said, the same cost initiative what we have done in the tractor business also. So it's the same team now working in the construction side, because we integrated the back end now for both the businesses, and they are working on this cost initiative again on the material cost front and construction equipment too. And that benefit also will start flowing in, but it may not happen in next year alone. But yes, like you said, our long-term target is to be in the range of 7-8% sort of EBIT margin in construction equipment business. So maybe another 2-3 years time we should be able to reach there.
The second question on the tractor side, you said 7 to 9% growth for the next year. Within this, sir, which region do you expect to outperform strongly? From where you are seeing positivity?
Yeah, so this year so far, it's pretty much the growth has been very widespread and very equitable. But in the current, let us say in the current few months, like last month and following months, South will grow a little bit faster than the North. I think for the next year, it will be also more equitable. So growth will happen North, South, East and West. The growth will be more or less same.
Thank you, sir. Thanks for my.
Thank you. We take the next question from the line of Raghunandan from MK Global. Please go ahead.
Congratulations, sir, for a good set of numbers, and thanks for the opportunity. Sir, on the new products and tractors, could you throw some light on the potential for these products, be it on the compact tractor side or the specialized tractors you are looking at in terms of for paddy applications?
Yeah, so we, as Bharat had explained, we have launched or in the process of launching 3 new products in this quarter. So one is this farm track compact tractor. There is a growing market for this kind of a tractor. This is roughly like 20 to 30 horsepower category, four-wheel drive, small size tractors. The market is essentially in the south and some hilly areas, but Maharashtra is a big market. And we have been absent in this market so far, right? And therefore, we really think that this product will give us better coverage, not just in market share, but also in terms of our channel strength in these markets like Maharashtra. So that is one. The other product that we have just launched or in the process of launching is also a rice special. This tractor is a 45 horsepower four-wheel drive tractor. It's a very unique tractor in the sense that it's a right combination of the weight and the power. And so this tractor is also going to address white spaces for us. We never had such kind of a tractor. And then again, there is another model which we are going to launch very, very soon. Is a 45 horsepower tractor in power track range, which we had never had a tractor in that segment also. Right, so all of these tractors are covering white spaces and therefore should give us additional volume and market share.
So how do you see the penetration happening in the southern markets, and what is the aspirations there on the market share in the medium term?
Yeah, see, the aspiration for the southern markets is, a few years ago we were at between 2 to 4% market share in most of the southern markets. And this includes markets in west and the east also, where we have been traditionally weak. And good thing is that in the last 2 years we have grown in every, or let us say most of the southern and the western markets, which is like AP, Telangana, Gujarat, Maharashtra, Jharkhand, West Bengal, Chhattisgarh, Orissa, etc. Right, so there is a good momentum. There is more fundamental hygiene level of work we have to do, which means creating a brand presence and creating a strong channel, which takes a little bit of time. But the good thing is we are continuously increasing market share almost every quarter in these markets.
And can you also comment on how things are ramping up on the exports market and how these new products will be rolled out and how you expect things to ramp up over the next few years?
So on export, like you said, this year we're looking at roughly touching 2,000 tractors mark. And next year we're again looking at targeting about 3,000 plus tractors. So the long-term vision was to really reach in terms of numbers, roughly 8 to 10,000 tractors in export in 4 to 5 years time frame. So that plan is very much on. So I think we are working on that direction only. So whatever new markets need to be open to do that, they are being implemented. So in the market like Brazil or Mexico or US or Europe or the market in the Middle East or in the Turkey and Algeria region and also in the Southeast Asia, which are the focus market for us. So these markets are being penetrated now, and gradually we are expanding the portfolio as the product starts coming into the portfolio. So like in the compact tractor has a very good market overseas, so that will be another volume booster for the export segment. So which will also help us in getting numbers there.
Thank you, sir. One query on the construction equipment side. This year, the industry is growing at 20%. We might do better than the industry. How do you see the growth panning out for the next year?
So we still expect the construction should continue to grow at this range. So maybe 15-odd%, something which we think is sustainable number, looking at the kind of public spending which is likely to happen with this government and the kind of infra project the government is committing itself to. So if that continues, so maybe 15-odd% growth will continue for this sector.
Thank you, sir. Thank you very much. That was very useful.
Thank you. We take the next question from the line of Bharat Gainani from Sharekhan. Please go ahead.
Thank you for the opportunity and congratulations on a good set of numbers. My question was basically you in the earlier comment highlighted that FY19 is expected. I mean, you expect the industry to be the peak for the tractor industry. So, but if you see the ground factors, the last 1 to 1.5 years, there has been a considerable increase in the MSP prices. 2 years, the crop acreage is also good, and the rural income is on the higher side. So, what makes you think that like FY20, the industry may witness a downturn? I mean, I just wanted to get a sense of that. So, if you can just throw some light on that.
See, one obviously, like you said, is we know the last 2 years the industry has been growing. Last year growth was 18%, and this year again we look at 15-16% growth happening in the industry. So you're already sitting on a very high base in the industry cycle. And normally, if you look at the monsoon trend also, normally every 2 years, 3 years, you see a cycle getting reversed. So again, you see probably good chance that probably next year the monsoon may not be good. So obviously that will be one indication that will be there. But also because the election year being there, so a lot of subsidy programs are coming from the government in next year. And this year also we're seeing that demand actually linked to that demand increase happening on the ground because of these reasons. So the policy-led initiative which normally come in this year will lead to a lot of preponement of demand to FY19. So that's why you see when the preponement happens, so normally you see post-election there will be some correction which is going to happen. And obviously it's too early to talk about in terms of the growth for the sector for next year. But a lot will depend on how the early rains happen, how the monsoon spread is on all India basis. But our indication is since we have seen the good base now in the last 2 years, the growth has been good. And this year already the industry is touching a new peak. So we expect probably the growth momentum will be slightly lower next year. And maybe FY20 onwards we will see some traction start happening in the industry.
Okay. Fine. Second question is, any update you can provide on the inorganic growth areas that highlighted for the railway business? So any update on that? Would you like to comment on at this point of time?
On the organic side?
Inorganic side, because we indicated that we had sold some treasury shares in the last 2-3 months for inorganic growth opportunities in, I guess, the railway segment. So can you provide any update on that at this point?
We have some deals on the table which are getting evaluated. So maybe I think we expect to close one of them maybe in the next 3 to 4 months time frame. So probably we'll come back to the market when the deal is finalized and closed.
Okay. So can you just give an indication whether it will be on a product which is a high margin compared to the product currently we are having? Just any rough indication you can give on that.
I think it's too early for me to really talk about that because we don't know which one will get closed, so obviously. But yes, what we're looking at is since there's a good opportunity in the segment, in the railway business itself, and normally the segment has high margin. So obviously whatever category we go into, obviously definitely it will be a high margin category only.
Okay. And sir, my last question is that if we assume that FY20 may probably be a flattish or kind of a negative, slightly negative year for the industry, and maybe consequently for Escorts as well. So in that event, do we still stand by the guidance of attaining a 13 to 15% kind of an EBIT margin? Because I think that was the target that we had set, and in this quarter we are very close to that target. So in the event if FY20 turns out not to be good or flattish, so still we will be able to keep that 14-15% kind of a range, or do you expect some pressures if the volume remains flat or slightly negative? That would be my last question. Thank you.
Well, I think like responded to the earlier question of this. So our target is if the industry really goes down. So our internal target was even at a FY17 sort of industry volume numbers, we should be able to maintain double-digit margin for the tractor business. And we stand by that guidance, and that's what the company is working on for. So even after 3 years, if for 2021, if you see a decline happening in the market, our target will be still to maintain double-digit margin in this tractor business. May not be 13, 15, I don't know, but I think it will be still double-digit.
Okay. Got it, sir. Thank you and all the best.
Thank you.
Thank you. We take the next question from the line of Mayur Milak from India Nivesh. Please go ahead.
Yeah. Hi. So I was just looking at your staff cost. So between Q1, Q2, and Q3, we moved from 115 crore to 130 crore, and then now we are down to 105 crore. So any specific reason why this quarter has the staff cost at such a low amount?
So like I said, there's some initiative that the company had taken for the isolation of the manpower. So there is some benefit has started accruing from this quarter onwards. And there's also in the Q2 normally all the increments for the white collar staff really gets implemented from second quarter, from the 1st of July. So that's why we saw some spikes happening in the Q2 numbers. But in Q3 numbers, the rationalization impact is now started coming in. And we expect probably this will be the number, which will be the run rate for the company going forward too.
Okay, so this is basically the kind of number that we are looking at regular without really having any specific one-offs into this.
That's right.
All right, and so our VRS plan was put to some halt. Do we see any revival into that?
So not immediately, because we recently concluded on that and we didn't get much response in September when it was launched. So that's why I think for another year or year and a half, we don't think we'll be really coming out with another scheme. But yes, maybe in the next, maybe FY19 or FY20, probably at that time, we will reframe the scheme and see whether we can actually launch it and really get a good number at that point in time. But not in the immediate in the next few quarters.
Okay. And so lastly, just wanted to understand. So while on one hand we are saying that FY20 could be maybe flattish to negative, do we really then expect our cost initiatives to really be strong enough to make up for that decline that will gradually happen in the top line? Because I assume if operating efficiencies might also come to a kind of impact with lower sales. So will we able to continue the run rate?
Well, that's what the company is working on. So I think management, the target is that only entirely. But I think it's too early to really say whether it will happen or not. But yes, I think our internal goal post is that only. So even if there's a correction in the industry, we should be able to maintain the double-digit margin for the business. But yes, like you rightly said, so the operating efficiency probably will reach its peak maybe next year. So we don't expect to be margin expansion possibility happening beyond FY19. So if the industry, unless the operating leverage comes from the higher volumes, so the industry shows further growth. But if it doesn't show further growth, probably you'll see a peak happening on the margin next year.
Okay. And on this input hike, have we really been able to pass on all the increase in the raw material prices, or there is still some left? And with this hike that we've taken in Q4, have we been able to pass on the entire hike?
See, so far till YT numbers till December, we were able to pass on the increase, but obviously the pressure on the commodity side continues. So steel prices are further going up. So obviously we'll have to relook at the numbers again, and depending on how the competition reacts to those price increases, we'll take a call and passing it on to the market. But so far we've been able to do that.
All right. Great, sir. Thank you so much.
Thank you. We take the next question from the line of Amin Pirani from Deutsche Bank. Please go ahead.
Yes. Hi, sir. Thanks for the opportunity. So my question is on the tractor growth. During the last upcycle in tractors, we had seen that the share of non-farm usage had increased materially. And now that we are, 2 years into the upcycle and hopefully we'll have another year of uptrend, has the share of non-farm increased and how would it compare versus the last upcycle that we had seen 4-5 years ago?
See, the share of non-farm is gradually increasing. It is increasing at a faster rate than the share of agri, right? And I think it will continue to be so for next few years because there is a lot of latent demand there in the non-farm segments.
Okay. So, broadly speaking, what would be the replacement cycle, if a tractor is used purely in agri or if a tractor is used for dual use, both agri and non-agri? Is there a significant difference in the replacement cycle then?
Yeah, small difference. In agri, it used to be about 12 to 15 years earlier, but now it has dropped down to about 7 or 8 years.
Okay.
Right? In non-agri, it used to be about 8 to 9 years, but now it is about 5 years.
Okay. So if the non-agri continues, then even beyond FY19, we could have some triggers for growth, even if, say, monsoons and other things, are not very favorable. Would that be the correct thing to look at, or?
Yeah, it does help. If non-agri continues to grow, it does help in a downturn of the agri cycle. Right? It does help to kind of create some cushion against the degrowth.
Okay, sir. Thanks for the opportunity.
Thank you. We take the next question from the line of Chirag Shah from Edelweiss. Please go ahead.
Yeah, thanks for the opportunity. Sir, I missed the point on the price hikes that you indicated that you have taken on Q4.
Yeah.
Hello?
Yeah, what do you want to know on that?
The price hikes that you have done in Q3 as well as Q4.
No, so in Q3 we have not taken any price increase, but we've taken it in Q2. So on the cumulative price increase so far in this year is roughly 2%.
And this includes even Q4 price increase, right, sir?
Yeah, including Q4.
Okay. And is the commodity cost pressure already felt in the P&L or not yet?
No, so it is, what happens is normally, and we take a price hike in the commodities and that gets passed on to the market with a lag. So that lag is the period where you actually get an impact on the P&L side. So I think that's something which is a concern. So in the inflationary condition, that remains a challenge for us to manage.
No, sir, because what I was trying to understand is if I look at sequentially, your gross margin is largely flattish. So does this reflect commodity cost pressures or not? Not really. The recent uptick in the steel prices that we had seen in Q3 and some part of Q2, have they reflected in our P&L?
Oh, so like you said, in the Q2 we already taken a price increase, so that effect is already coming in Q3. So sequentially, the material cost wise, if you look at, there's hardly any change.
Yeah.
So that's why the gross margin has been more or less in line. But yes, there was some one-off impact which was there in Q2, which has led to better margin this time. So the GST transition impact which was built in the sales line in Q2, so that obviously has not come in Q3, which has led to a higher, better realization looking at in the Q3 numbers, which is leading to this increase in the margin.
Fair point, sir. And the trend is likely to continue.
The trend of the higher commodity prices or the flattish gross margin?
On the margin front, how do you look at it? Can it improve for yourself or gross margins, or the cost pressure, the commodity cost pressure is far severe in Q4 versus what we have seen?
I think since we are coming up with the new product category which are into the lower HP segment, like we said, we launched compact tractor range which is sub 30 HP segment, which normally is a lower contribution item. So we expect even whatever saving we do on the cost side, that we will get offset with the slightly adverse product mix which will happen because of these new products. So overall, we don't expect it to be a major change in the gross margin side going forward.
Fair point, sir. This is really helpful. All the best, sir.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. We take the next question from the line of Samir Deshpande from Fairdeal Investments. Please go ahead.
Hello. Congratulations, Mr. Madan and all the team for the excellent performance, and particularly on the margin front and everywhere the growth has been very healthy. And actually, I wanted to know some of the treasury stock was sold in December 2017. Some 36 lakh odd shares were sold by the company, and that is the benefit trust. So you are having this 250 odd crores in cash with the company now at this point?
Yeah, so the cash is very much with the company. So like you said, the purpose of the sale of shares was to fund the inorganic opportunities which are company is evaluating as of now, and which probably will get materialized over the next few months. So the cash will definitely remain with the company till that time, and will be purposely intentionally used only for looking at the growth opportunities going forward.
Yes, sir. Definitely it will help us because we don't need to take any debt on the books. So currently also I think we are debt neutral, no? We don't have any net debt.
Yeah, so net debt basis, we have in the last 5 quarters, we have been net debt is negative. So that situation continues to be so. The debt has further come down in December quarter, and probably in March quarter we'll look at it going down further. So I think that way, maybe somewhere during next year probably will be virtually debt-free company.
Yeah, and this 250 crores odd amount and money can be used for the acquisition. That will be helpful.
That's right.
Yeah. And regarding this VRS, you mentioned that it is not likely to happen in next year or so?
Yeah, because we recently concluded one VRS scheme which was not very successful. So the acceptance levels were very low. So that's why we want to give a break in between. So maybe another 1.5 to 2 years sort of break is required before which we come with this another scheme.
And in Q4 also we expect the tractor sales also to grow by about 15-16%?
So Q4 we're looking at slightly higher numbers. So maybe we're looking at anywhere between 20 to 30% growth possibility remains for Q4.
Okay.
Partly because of the preponement of the festive season. So the Navratras are falling in March this time, which normally used to be a split between March and April. So this time everything is happening in March. So as you see pretty good numbers happening in this quarter.
Okay. Thank you and all the best to you.
Thank you.
Thank you. We take the next question from the line of Ankush Agarwal, an individual investor. Please go ahead.
Sir, my question is regarding railway equipment division. See this order book of 330 crores. What is the approximate timeline for execution of this order? And another question is, where do we see this revenue for railway equipment division and construction equipment in next couple of years or so?
This 330 crores is the initial order booking what we have now. We should be executing it in the next maybe 2 to 3 quarters, and we are hopeful that obviously our order book would be more in the coming this quarter and the coming quarters. So that is the response to the first question. While for the second question, why do we want to see? We have taken up quite a leapfrog effect that we will be multiplying a few times in the coming 3-4 years with the product profile what we have. I will not be able to give you exact numbers, but we are pretty hopeful, and we are pretty confident that we would be growing in few multiples of our present top line in the coming years for railways.
Okay, and same for construction equipment?
Yeah, so construction also, so like you mentioned, so we expect only 15% sort of growth will happen, likely to happen next year too. And if the same momentum continues on the government side, on the public spending, especially on the infra side, so probably that sector will continue to perform better.
Okay, thank you, sir.
Thank you. Next question is from the line of Nitesh Sharma from Phillip Capital. Please go ahead. Mr. Sharma, your line is unmuted. Please go ahead with your question.
Sorry, thank you for the opportunity again. Continuing with railways, so what proportion of revenues during the quarter would be through new products and what would be through our traditional products? If you could help us with the number.
You're talking about the coming Q4?
No, Q3.
Q3 around only 10 to 15%, I would say, would be from the new products. Rest is still from the conventional products. Q4 it will be higher, and in the next fiscal year we are confident that it should be still higher than maybe 30%.
Okay. So, and what proportion, what would be the localization content for the new products currently?
In the new products, except for the axle mounted disc brakes, we have the majority of the new products like the BMBS and the new coupling systems and the new suspension systems. These are all our in-house development. So obviously, every of them are already localized. For the axle mounted disc brake, we are working with railways for the localization. We already have put down all the plans for localization. So we are waiting for the localization approval plan from the railways, which should be clear in the next 2 quarters.
Okay, got it, sir. And Mr. Mandar, if you could help us understand, in the construction equipment industry, we are seeing consistent strong improvement in terms of volumes. So has it led to an increase in the pricing power? How are various players playing around with the pricing? Is it easier to take price hikes, and hence next year could be a big surprise as far as margin goes, led by pricing power for the industry coming back?
In fact, entering into this quarter, we have done a price increase. There was a slight price increase that we did on all the product range. But the problem is, the majority of the markets or the competitions, they are still waiting and watching for the right demand to come so that their capacities are filled and they are able to pass on the price increases. We are optimistic that most of the players would start increasing their prices, as the inflation pressures are very, very heavy now. So we expect in this quarter, towards the end of this quarter, some price increases are going to happen. Nevertheless, we are going ahead with our price increase. We have already done one price increase in January. And I think, as we go along, probably we have to, because this industry cannot bear that blunt of inflation. The inflation is too very heavy now.
Okay. Got it, sir. Thank you very much.
Thank you. We take the next question from the line of Sangam Iyer from Shubhkam Ventures. Please go ahead.
Yeah, hi sir. Congratulations on a great set of numbers. Actually, I missed the early part of the call. Did you give it the timelines in terms of the two new products that we were looking to launch early next year? When are the timelines that you're looking for that rice tractor and the other one also as well?
Is this from tractors or from railways?
The tractor ones.
Oh, tractors. Okay. So yeah, so we have actually launched two new products already. We were a little bit ahead of time. So in the last few weeks, we have launched two new products. So one is a compact tractor, which is basically a specialized tractor for orchards and vineyards, and also finds some application in row crop farming. So this is a four-wheel drive 26 horsepower tractor. This used to be a white space for us. We never had a tractor here, and the industry is growing quite a bit in some of the markets in India. Also, this will help us in exports in a lot of countries. The other was a paddy special tractor. This has been also launched in a few limited quantities right now. And of course, this is a very unique tractor which is not available in India from any manufacturer. This is a very good, this is a lightweight 45 horsepower tractor. This is a good combination of weight and power. Right, so both those products are already in the market.
Great. So, sir, in terms of the volume growth for the agri-business for next financial year, when we were giving the guidance, I mean, what's the kind of growth? Because I missed that part of the statement.
The industry growth is looking like we are estimating about 7 to 8% for the next year.
Mm-hmm. And from our perspective?
This year will close probably around 15-16% over previous year. So we are already sitting at a high, and we are projecting another peak next year.
So should we be, I mean, given that we are entering into new spaces where we are not present, should we be, growing at a much higher pace, say maybe 1.3 times or 1.4 times, like what we did this time around in terms of the volume growth?
Yeah, the plan is to grow at a higher rate than the market. So with help of new products and other initiatives that we have.
Sir, just one more question. I mean, during the quarter, we saw that the realizations were much better as compared to on a sequential basis. So, was there a change in the product mix, and how do we see this, going into the Q4 when volumes come back?
This is the earlier part, so we had explained that thing.
Sorry.
So I think
I'm sorry for that.
Actually, since in the last quarter there was a one-off impact which was coming from the transition to GST scenario on the tractor side. So there's a one-time compensation which was given on the stocks held by the dealers, by the channel partners. So that impact has been negated now in this quarter. So that itself has an impact of roughly 13 to 14,000 rupees per tractor in this quarter volume. And then there's also a non-tractor sale revenue which has gone up. So compared to the last quarters, so this quarter the number of tractors sold are less than the last quarter in Q2, but the non-tractor revenue has gone up. So there's another 5 to 6,000 impact which is there. And third reason is the price increase which we taken in Q2, the full impact of which is now coming in Q3. So all three factors put together led to the higher realization. And this is the run rate which we expect will continue going forward too.
Great, sir. And on the margin front, should we be expecting a better margin profile given that now we will have a full year improvement in the construction business margins as well, because as we what we saw in Q3, a full year impact would come in the next financial year, and also given that we are moving into better realization products with the two new launches that are coming into the system.
Yeah, so like we said earlier, again, nothing I'm repeating. So we had given a guidance of further margin expansion of roughly 100 basis points for next year over current year. So that we expect probably should be the peak which will be touched next year with all three businesses doing well.
Okay, great, sir. All the best. I'm sorry for repeating the questions.
No problem.
Thank you. We take the next question from the line of Kaushik Dani from Reliance Wealth. Please go ahead.
Good evening, everyone. Basically, what I see here in the presentation is that currently promoters plus trust is roughly 40% of the holding, right?
Yeah.
So out of this post sale of shares of the trust, now how much does the trust hold in terms of percentage?
So roughly 27% is still held with the trust.
27?
Yeah.
Okay. Typically, I think it's a good thing that, we have been using this as an opportunity to do some acquisitions. Let's say in case in future some more opportunities come into the space, can we continue to use the trust shares in a similar fashion? What sort of thought process we have?
See, I think it will depend because we are also looking at good profitability and better cash flows from the operations. So depending on, yes, if there's a very good opportunity and there's a requirement, so we can definitely use it. But as of now, since we already sold 3% block and we are still sitting on that cash so on the balance sheet, and we are looking at next 2-3 years generating very good cash flow internally also from the local internal accruals. So we don't expect there'll be really a need to do that. But like I said, if something really comes exciting for us before us, so definitely we can look at that option.
Yeah. So is there any some sort of minimum threshold mark which you would want to have? You don't want the holding to go below X percentage or something like that?
Well, the holding, this is credit shares and nothing to do with the holding. So promoter holding is different from stock which the company is holding. So unless, like you said, the regulator comes out with a new guideline which restricts the companies to hold its own share, unless we are forced to sell it in the market. Otherwise, unless some good opportunity really comes our way, only then we'll be using these stocks for acquiring those.
Right. The last question was with regards to this construction equipment. I believe from my calculations, I think 300 to 350 units per month is the sort of break-even sort of scenario. And as we see that, let's say the economy improves and things start becoming better, typically, and that's one of the reasons as to why now we have a bit positive. And now I believe for 9 months, I think it's just break even, as well as for 3 months it's 2.2%, right? So assuming a 20% industry growth rate that has been suggested, can we come back or let's say reach levels of around 5 to 7% in next 2 years?
So like we mentioned earlier, so again I'm repeating, so we had mentioned that in next 3 to 4 years we're looking at a EBIT margin going to 7 to 8% level in construction business, because we are working on many cost initiatives again in that side. So with the volume also going up, the industry doing better, and we given 15% guidance for the industry there. If that continues to happen, then definitely we are looking at reaching those numbers in 3-4 years time.
Yeah, we all know that construction equipment is basically it's a very diverse industry, right? But then also just for the sake of theoretical, what sort of market share we have?
So market share varies. So like we got a leadership position in pick and carry cranes, which is 40% plus market share, which we enjoy.
Okay.
And the other two categories is compactor and backhoe loader. Backhoe we are very insignificant player with less than 2% or 2.5% sort of market share. On the compactor side, we are ranging between 10 to 12% sort of market share.
Okay, fine. Once again, congratulations for the great numbers. Thank you.
Yes.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to one per participant. We take the next question from the line of Nitin Kapoor, an individual investor. Please go ahead.
Hello. Hello.
Hello. Yeah, we can hear you.
Thank you, sir. So just wanted to know what are your projections for the next, 4 to 5 years in terms of revenues and EBITDA margins overall?
So company is in the process of working out the 5 years plan. So we are hosting our investor day on 7th of February in Delhi NCR. So I think at that time we'll be unveiling these plans for the next 4 years. So so we will like you, if you are interested, then definitely you can join in and we'll be able to share those numbers with you.
Okay, great. That's wonderful. But any ballpark estimate? I mean, the likes of Mahindra's and Sonalika, when would we be able to kind of match in terms of margins? Would be able to
something for the investor day too.
Okay, that's fair enough. Thank you, sir.
Yep.
Thank you. We take the next question from the line of Ankush Agarwal, an individual investor. Please go ahead.
Thank you. So my question is on the tax side. I wanted to know if you can give a high-level breakup on the revenue share